Hello, everyone, and welcome to the Seafair webinar on agricultural risk management and climate change adaptation. It's Seafair's mission to translate high-level research and knowledge to a diverse audience that includes policymakers, elected officials, and federal administrators. When we demonstrate the value of our profession to these groups, we increase public appreciation for research, extension outreach, and academic programs in agricultural and applied economics. My name is Barnett, and I am professor and chair in the Department of Agricultural Economics at the University of Kentucky, and I'll be moderating today's session. I'm also a Seafair board member. As a little background on today's topic, current U.S. federal farm policy focuses on risk management. Projected spending for the federal crop insurance program exceeds that of all other farm-related programs authorized in the 2018 Farm Bill. Of course, agriculture has always been subject to the vagaries of weather, but climate change is likely to increase weather risk exposure for many farmers. The challenge for policymakers will be ensuring that future federal programs assist farmers with their exigent risk management needs while also facilitating adaptation to a changing climate. For these reasons, Seafair thought that a webinar on this topic was both timely and critically important. So now allow me to introduce our panelists. Tack is a professor of agricultural economics at Kansas State University. Dr. Tack's research focuses on issues related to agricultural production and risk management, with applications to climate change and crop insurance. Our second speaker will be Rejesus, who is a professor and extension specialist in the Department of Agricultural and Resource Economics at North Carolina State University. Dr. Rejesus's research focuses on applied production economics with special emphasis on agricultural policies related to risk management. Our third speaker is Brittany Goodrich. Brittany is an assistant cooperative extension specialist in the Department of Agricultural and Resource Economics at the University of California, Davis. Some of Dr. Goodrich's current projects explore determinants of participation in the Pasture, rangeland, and forage rainfall index insurance program, and that will be her topic today. Our last speaker is Belasco, who is professor in the Department of Agricultural Economics and Economics at Montana State University. Dr. Belasco's research interests are in the areas of agricultural marketing, risk management, and applied econometrics. So with that background, I'm going to hand the webinar over to Tack, who will start us off. Jesse?
Great, thank you, Barry, and thank you for the opportunity to speak today. There we go. I'm going to be focusing on the role that extreme heat plays in measuring climate change impacts as they relate to risk management and crop yields. I'm currently a professor in the Department of Agricultural Economics at Kansas State University. Next slide. This work really dates back to when it started, at least when Barry and I were colleagues at Mississippi State University, and there's been some good news, reasons to celebrate for Mississippi State recently. But yeah, so this research area that I've been engaged in has been for about 10 or 12 years now. Next slide. And sort of the big picture take-home message that I'm interested in communicating is that exposures to extreme heat are likely to increase under global warming. It's an interesting measure because it in and of itself, it's detrimental to crops. There's sort of a direct heat stress mechanism, but it also has an influence on drought. So there's also sort of this other mechanism that it can affect productivity through water deficit stress. This has the potential to reduce average yields, but then also the risk around those yields. And a lot of what's been done in the literature is focused on short run, sort of no adaptation effects, and it's important to consider that adaptation is a very real possibility, and so I'll be talking about that a little bit as well. In that context, focusing a little bit on irrigation, and then sort of moving forward this intersection of climate change with some other frontier concepts in production, cover crops, pasture, forage, rangeland, and ag policy is also important. Next slide. So this paper came out in 2009. This is exactly when I started at Mississippi State, and I was sort of a freshly minted PhD, trying to figure out what I was going to do for a career in research. And Mike Roberts and Wolfram Schlenker published this paper that same year, and it was really fascinating. And it showed us how to measure heat. And it turns out in this research literature, measuring heat is everything. And when you start getting those measures of heat correct, you can start diagnosing how detrimental they can be to crop productivity. But it was really this paper in 2009 that taught us how to measure it in that way. And it's really been the foothold for all the research that's followed that is focused on extreme heat in the context of climate change. Next slide. So current day, literally a paper that was published within the last month or so is moving towards analyses where we're detecting the effect that climate change has already had and diagnosing how much of the sort of risk arena is being influenced by it. So Diffenbaugh et al., this was published just this year, show that global warming has already contributed to substantially rising crop insurance losses, and it's not a trivial amount, 19% of national crop insurance losses over the 1991 to 2017 period. So if you think about in those 12 years, a lot has happened. We learned how to measure heat just in 2009, and 12 years later, we're already diagnosing some traceable effects that this heat is having in this risk management context. Next slide. How are people experiencing climate change? There's sort of this emerging narrative of a tale of two Americas. So this was a New York Times article within the last week or two, and you can sort of split the US in half. We've got a half that's getting wetter and a half that's getting drier. Next slide. Focusing on the temperature side of things, we see this split again. This IFPRI blog is really fascinating and helps us understand sort of the politics of climate change and temperatures. So you have half the country that has already experienced an increase in July temperatures, which are crucial for crop production. And then you've got some pretty major crop producing areas that haven't experienced any change in their maximum temperatures in January. So there's this idea of if climate change was actually occurring, farmers would be our first wave, letting us know that this is a very important issue. One thing that we need to be aware of is that this can be evidence that there's not going to be a detectable change, or it could just be that it's going to be a little bit lagged geographically. So this is an important consideration right now for thinking about the sort of the politics surrounding climate change and especially the policy that relates to it. Next slide. All right, so one of the crucial things for determining that heat matters was sort of disentangling water stress effects and heat stress effects as we sort of use projections of climate change. So here we have a great paper by Ortiz, Bobea et al., looking at 6 major US crops, and they're disentangling the effect that sort of water stress is going to have versus temperature stress. And the key insight here is that temperature stress is going to be a big deal. So under sort of climate change predictions, we expect that temperature changes are going to be playing a pivotal role. Next slide. Using a completely different data set, Hendricks comes to the same conclusion. When we're projecting climate change impacts into the future, this temperature dimension is going to be playing a crucial role. Next slide. As it relates to insurance, this is a work by Perry et al. Using insurance-based measures of yield risk. And what is really, really great about this data set is it tells you what the actual cause of the insurance loss was. So what this paper does is it simulates a change in temperature, holding precipitation fixed, and looks at the causes of losses that are going to be associated with that. The 2 big ones are on the left-hand side here with drought and heat. The important point here is you could have a context in which your precipitation stays the same, your rainfall, but your temperature changes and you're going to experience increased drought occurrences, all right? It's important to recognize that drought is not just a water-based measure. There's important interactions between sort of water supply and water demand, and a lot of that is governed by ambient temperatures. Next slide. In terms of the cost of purchasing crop insurance, again, this is an analysis by Tack et al. Warming temperatures, so holding precipitation fixed, what's going to be the effect of premium rates? All right, so this is corn in the Corn Belt. Premium rates can be thought of as sort of the relative cost of insurance, sort of a normalized out-of-pocket cost for producers. And the insight here is that it's not going to get more expensive everywhere. As we move further north, you could actually see some reductions in risk and cheaper insurance. But if we're talking about what is currently sort of the major corn producing states in the US, we're likely to see some increases in that cost of purchasing insurance. Next slide. So that's great. That all has to do with what if we had both hands tied behind our back and there was no potential for adaptation. The interesting question going forward is how can adaptation sort of interact with these short run effects to determine sort of optimal paths forward. So we as economists, we call these short run and long run scenarios. And there was a really great recent paper by Morell and Gammons sort of asking whether or not we can use just conventional regression techniques that have become standard in the literature to diagnose differences in what is a short run impact and a long run impact. And some of their findings pointed to the use of large scale data sets to sort of mitigate this concern. And in that case, the short run effect that you're estimating can be pretty representative of the long run effect. But they also found scenarios where the short run effect was likely to be very different than the long run effect. This is great and really useful information, but largely it's a diagnostic tool. It doesn't tell us what the adaptation is going to be. It tells us that there's potential for it, but we don't know what it is. So it's important that other research sort of step in here and start looking at specific adaptation mechanisms. Next slide. Every land grant institution in the US, not every, most, probably have some data that you've never considered using that can be really insightful for this regard. So here, Tack et al. Is using some field trial data that has plants by variety. So I can look at wheat yields by variety, measure the influence of temperature on them, and then sort of disentangle which of these varieties have some resistance and which ones don't. And the idea here is you're trying to quantify the genetic potential among existing varieties for switching varieties in the presence of warming temperatures. And at least with winter wheat yields here in Kansas, we're not seeing a lot of evidence that that's sort of a real promising adaptation strategy. Next slide. We saw the same thing for sorghum. So again, this is sorghum in Kansas. Sorghum is interesting because it already has a reputation of having a lot of sort of environmental hardiness, right? Some drought resistance, some heat resilience in it as a plant. This paper looked again at this potential for genetic heterogeneity and the potential for adapting through switching varieties. And again, pretty limited impacts here from switching. Next slide. Other thing producers can do is they can change the growing season. If it gets warmer, maybe you're sowing those seeds a little bit earlier. We looked at that here again for sorghum. This is with farm level data here in Kansas. And while you could reduce the impact of warming temperatures through changing the growing season, the impacts weren't substantially large. So you could do a little bit better, but nothing too dramatic. Next slide. Perhaps the biggest adaptation strategy, or one that is sort of going to ensure the largest reduction in negative effects, would be to switch from dry land to irrigated production. Water is the refrigerant of the plant's air conditioning. It is the thing that if it's available in ample supply, the plants can really use that to cool themselves down and mitigate the influence of these warming temperatures. Clearly, there's a problem with water. We wish we had more of it. Not all production regions have access to it, So there's definitely an interesting environmental natural resource constraint at play here. But it is important to realize that, there are outs here. Water is definitely one of those outs. Next slide. This is just one little part of the climate change research that's going on. I feel very privileged to be part of this panel with Rod and Brittany and Eric. Rod is doing really interesting work on cover crops and the intersection with climate change there. One of my colleagues here at K-State, Jason Bergtold, is also in this area. Brittany is doing great work with the PRF insurance program, Pasture, Rangeland, and Forage. Another one of my colleagues, Jisong Yu, is working in this area as well. And then Eric, recent research in this arena of agricultural policy and its interaction with climate change. Next slide. And that's it for me. Thank you for your time.
All right. Thanks, Jesse.
All righty. Whenever you're ready, Brittany.
Always fun dealing with all of these technical issues. Yeah, so I'm happy to be here with all of these folks that are doing some really interesting research. So we're going to talk a little bit more specifically about this pasture, rangeland, and forage insurance program. And this is joint work with Kelly Davidson at University of Delaware. So go ahead and get the next slide. So for any of you who are not familiar with this pasture, rangeland, and forage rainfall index insurance program, it's a relatively new program. It was introduced by RMA in 2007 as a pilot program. In 2016, and it was expanded to all 48 states or contiguous states in the US. And so really the goal of this program is to insure livestock and forage producers against forage losses that are going to probably occur due to low rainfall. So you can think of a livestock producer, if a drought occurs, they're not gonna be growing as much hay or pasture, so they're gonna have to either purchase hay or they're gonna have to sell off cattle earlier to deal with that. So this is the program to insure against that happening. So hay, basically the way this program works, it's not a traditional crop insurance program. It's an index insurance program. So the hay and pasture acreage is actually assigned to these NOAA grids. And then payments are actually triggered when rainfall levels fall below the calculated index, which is approximately the historical average rainfall for that specific grid. And so why use this type of index insurance as opposed to, more traditional insurance where you actually, base insurance payouts on yields? So there's a couple of different reasons. We're not going to go into all of them, but the big one is that if you're not having to, measure yields or calculate average yield over time for an individual producer, this is going to mean lower costs of implementation. And so we can think about this as we have, climate change increases variability. That may mean for traditional crops, well, all crops, but more crop insurance claims. So then if you have all of these loss adjustments for the traditional crops where you're having to deal with figuring out how much yield actually was affected, then for an individual producer, that really increases the cost of implementation. So next slide. So one of the big differences with this specific insurance program from more traditional crop insurance programs is that producers actually choose the months that they want to insure against low rainfall. So they have to spread 100% of their coverage over these 11 index intervals is what they're called. And so they basically place their coverage where they want to or when they want to insure. And so one benefit of this is that it allows producers to customize their policy because we know that producers have very different production practices and they may have different types of forage that depend on rainfall at different types of the year. So there's a big benefit to allowing this flexibility. One of the downfalls of this is that producers can insure months that don't matter for forage growth. And why that's a problem is because it increases their basis risk. And so that's basically the potential risk that they are not getting a payment when they actually have a forage loss. Or on the other hand, you could have a situation where there is no forage loss, but they're getting a payment. So we're using taxpayer money to pay producers when they're not necessarily having losses. Okay, next slide. So the big question is, why would producers want to insure months that don't matter? And so one of the things that I've found through researching this program is that there's a lot of crop insurance agents and companies that actually market PRF insurance as basically they use this NOAA data to find the index intervals that are most variable. And so they say, we know the index intervals to choose, the month intervals to choose that are going to have the highest probability that you're going to get a payout from enrolling in that interval. And so the big question is, are those most volatile months the months when forage growth actually matters, so that we're trying to decrease that basis risk for our producers? And so it's often that when you actually look at the data, winter months are often most volatile. So those are the months that are probably not affecting forage growth, but they're what producers are enrolling in. Next slide. So some work that I've done with Jisung Yu and Mani Vandeveer. We looked at producers in Kansas and Nebraska and actually found that they were enrolling in winter months that theoretically shouldn't affect forage growth, and that over time the trend was to do that even more so. And so you've had some other research by Westerholt et al. That suggests there could be a better allocation of government resources if we drop intervals. We don't allow producers to pick intervals that don't coincide with the growing season. And so this is actually a proposed change by USDA RMA. So should we eliminate the intervals basically from October 1st to March 1st when those intervals presumably don't affect forage growth? And so the research question that Kelly and I are looking at here is, can we accurately identify the relevant rainfall months for an individual farm or ranch? And so I note this by Keith Coble and Rod and some others. In a review of PRF, they note that there is wide variation in the relevant rainfall months due to the different species, production systems, and so it may be difficult to actually identify which are relevant. Next slide, please. So the way we did this is Kelly and I performed some livestock producer education, and then we also had them do a survey at this time as well. And we did this at 2 regional farm shows. And so we just asked producers, in your experience, in which months is precipitation most important to forage growth for your hay production on your operation? And we asked for pasture production as well. Next slide. And so these regional farm shows, the one was done at the New York Farm Show in Syracuse, New York, and the other was done at Sunbelt Ag Expo in Moultrie, Georgia. So you can see the number of participants sort of corresponds with those different regional shows. Next slide. So one question we want to know the answer to is, do important months for grazing and hay production differ? And why we care about this is because we often, when we're talking about PRF, we're often using hay yields to figure out which months are important for rainfall for forage growth. So we want to know, do they differ between the pasture and hay production? Next slide. So the graph on the left shows the distribution of the different important months that were stated by our participants for pasture land and hay. The pasture is on the left is the lighter blue, and then the hay is the darker blue on the right. And so these distributions look fairly similar. So, you know, just looking at it, eyeballing it, it would be like, okay, they're pretty close. However, when you look at, so we looked at the individual participants to see if they said the same months across hay and pasture. And so what we found was only about 33% said all 3 months were important, all 3 months the same importance across hay and pasture production. So what that says is that our conclusions that we you know, develop based on hay yields regarding important months may not actually translate to pasture production as well. Next slide. So then the next big question is, do their important months actually occur during the growing season? So we call the growing season in line with RMA's proposed change from April to September. So next slide. And so this is the graph for hay growth, and you can see on the right-hand side just the percent of participants that selected each of the months. And for the most part, 95% selected months during the growing season, and there were about 5% that selected months outside the growing season. Next slide. And similar for pasture growth, you had 92% that selected months during the growing season, but you did have these 8% of participants that were placing importance on non-growing season months. Next slide. So then the big question becomes, well, maybe not the big question, but we also want to make sure that, you know, because we have these people that are enrolling in PRF and choosing winter months, we want to make sure that the people that are stating non-growing season months are important, are not just being driven sort of strategically by the people who were previously enrolled in PRF. And so this slide basically just shows that they look similar across whether they were previously enrolled in PRF or whether they were not previously enrolled in PRF. Next slide. And so this gives you an idea by region where respondents are who are stating that important growing season or important non-growing season months are for their hay or pasture acreage. And so you can see in the southeastern states, there's oftentimes higher percentages of participants that are stating, you know, certain months that are not in the growing season are important. But you still have in New York and Pennsylvania, people that are indicating that non-growing season months are important for forage growth. Next slide. So we also want to know, do participants within the same county identify the same important growing season months? Next slide, please. And so what we find here is that we did some within county comparisons of participants. And so we basically just say, did they select the same months? And only 13 and 14% of participants within the same county actually selected the same 3 months that were important for forage growth. So really what this means is that there is pretty significant variation within a county for important months. Next slide, please. So in summary, you know, do the stated important months for grazing and hay production differ? Yes, only 33% said the same 3 months for both grazing and hay production. Do participants typically select growing season months? Mostly there were 5 to 8% of participants who stated non-growing season months were important. And do participants within the same county identify the same important growing season months? And that's no, only 13 to 14% had a complete overlap of their stated important months. Next slide. So what are the implications for PRF? So we basically, with this research, we're finding that this flexibility is very important and really supports the statement that there is wide variation in relevant rainfall months due to the different types of forage production systems and rainfall patterns. So this proposed change of determining where to eliminate winter months is going to be difficult. So we had participants even in the Northeast say that non-growing season months were important. And so we know that climate change is likely to increase this variability. So we're going to not be able to easily identify what those important months are. And so another thing we find is that, should we be using hay yields to determine when months are important for precipitation for pasture growth? I'm not sure that I have another better way to go about doing it, but it does call into question this practice. And so I do put a caveat in here that these regions are likely more variable in terms of rainfall and forage growth than others in the US with more hay and pasture acreage. So these implications could be specific to these areas, but these are areas with very low participation in PRF, so it may be something we need to look at going forward to help increase participation if we want these producers to have this risk management option. Next slide. And I think that's all I had for PRF. So thank you to the Seafair group for having us on.
Okay, thank you, Brittany. I think we're going to go next to Eric Belasco, and then hopefully we can circle back to Rod at the end. So, Eric?
Okay, great. Well, thank you so much. It's an honor to be part of this program. I'm huge fans of all the work that Jesse and Rod and Brittany do. So it's great for me to watch kind of the stuff that they're working on, but also it's an honor to participate. So thank you to Seafair and the whole group, Barry Barnett, for organizing this. My talk is going to be a little, I guess, bigger picture, as the title describes, rethinking agricultural policy responses under climate change. Next slide. So as I think Jesse did a really nice job of talking about the increased reliance on weather in some of these different climate change scenarios. And really, if we think about what's in the domain of crop insurance, it really is high temps, drought, it's precipitation, and there's a lot of work really going into, as Jesse was saying, well, is it temps, is it water? What are the sort of the indicators that we should really be paying attention to? And that's really exciting work. I think one of the results of that is kind of a growing momentum to use crop insurance as kind of a larger part of the federal agricultural safety net, whether it is temperature, drought, wind, whatever it might be. With crop insurance, we've seen increased participation over time, obviously with the loss ratios flattening out, what the impact will be on that in the future. We've also seen increased participation. So I think those are all good things. There are two things I want to focus on in particular, and I think it's really contingent on a growing crop insurance base. If we are going to rely on crop insurance as a federal safety net policy, I think we need to confront these two issues, and they're both sort of equity related issues. The first one is in participation gaps that we see in some underserved groups, and I'm going to talk a bit about a survey we did a couple years ago to capture some of those thoughts. And then the second one is just the consolidation of benefits within crop insurance subsidies. Next slide, please. A lot of what I'm going to be talking about first comes from this report, which I have the link there, but I think there's a link on the Seafair site as well. It's Is Organic Farming Risky, which we wrote with some colleagues at NCAT and I think there's a lot of interesting findings in there. I'm going to talk about a few of them today. Next slide, please. So the first one is what I'll call the organic participation gap. And there has been a huge growth in the number of organic policies, programs, and acreage over time. That being said, there's still quite a gap between organic and conventional producers in their utilization of crop insurance. And again, if we're relying on a federal program that's going to really rely on participation, then we need to find ways to increase participation in some of these underserved groups. As you can see here along the bottom, you have percentage of production that is certified organic. 0%, we'd call those conventional producers. That's about half of our sample. We have about 1,200 survey responses here. And the orange line there is they have a history of buying crop insurance. And as you can see, that's, this is the survey that was really tailored more towards small and diversified operations. So 45% you wouldn't find in some of the larger crops. But it is, quite a bit higher, and it certainly decreases the more organic, a farmer gets. So clearly there are other risk management strategies that they're using that do not include crop insurance. Though I will note that the interest in learning more about crop insurance is fairly stable across this entire population. Next slide, please. We also see some participation gaps by crops. So, here I'm in Montana, grains and legumes have very high participation rates. But we look at some of these other crops, especially high value specialty crops, there's a huge gap between, we look at the participation rates in some of those programs, they're pretty small. Now, the Army has introduced a lot of new products in that area. So there could be some catching up to do. And maybe as those new programs gather steam, we see some increase in there. But certainly, we look at this as, somewhat of an underserved group by the crop insurance mechanism right now. Next slide, please. One of the most interesting findings, I think, was linking participation in crop insurance to history of, bank loans. And I think it really targets, helps us to target, if we're not hitting certain groups, it really is people who, don't utilize banks, maybe they're less commercialized than some of the other operations. And so one of the recommendations we've had for some education groups is to integrate more accounting and record keeping into some of those risk management education programs. Next slide, please. And one of the things we're able to ask, and this type is really too small, but as you can maybe see, we asked people why they didn't buy crop insurance for those who didn't. And some of the biggest answers were, my farm's too small, it's too complicated, my farm is too diversified. And clearly there are programs like Whole Farm Revenue, which are supposed to or intended to really hit these audiences. But one of the things that we found in this report was that those aren't really the audiences that are being that are using some of those programs. A lot of them are existing customers, and so finding ways to reach out to operations where they just feel like current crop insurance is just too complicated, they're too small, it's not worth it. I think that really should inform future education efforts in this area. Next slide, please. All right, so the other area, so we have underserved groups in certain areas, specialty crops, organic production. The other thing is looking at our traditional crop insurance program. And if you think about the concentration in crop insurance payments, which really goes back to subsidies. So we had this paper in 2019 with my colleagues, Anton Beckerman and Vince Smith, where we looked at, we estimated the subsidies associated with different farmers using data from the ARMS. And what we found was that the subsidy, not just the concentration of payments or the proportion of subsidies are going to go up for some of those larger farms. So as you go kind of from left to right, those are larger farms in terms of crop sales. So the far right bars are the top 10% of crop sales. So not only is the proportion of subsidies around 60% for that group, but it's also notable that the subsidy per acre is increasing for those groups. So you can see the blue line is really just it's almost a linear trend moving up. And really you can think of that as being tied to liability as those larger farms, benefit from economies of scale, maybe better technology. They experience higher yields as well. So the concentration is not just coming from size, but also just from some of that scale. Next slide, please. And so one of the proposals that was made under the last farm bill was, to cap some of those crop insurance subsidies at $40,000. That was under the Affirm Act. And so we did some analysis there, and you can look and see it really is hitting some of those larger operations, which you would expect. If you look at the top 5% sales quintile, about 43% of the farmers in that are impacted. So think of that as like around 2.5%. Overall, if you look at that bottom line, you see about 5% were impacted to some extent. And so that was one way to kind of bring some of that, those equities or disequities back in line. Next slide, please. And kind of building on that, looking at some current research we have here, we compared the 2018 MFP and the 2019 MFP programs. And one of the notable thing is we have different policy designs there, where the 18 program was based on production and the 19 program was based on planted acres. And one thing that's notable to me is you look at the orange lines look pretty flat. And whereas the blue lines, which would be for the MFP program, have that same feature, that crop insurance. So whether through caps or through policy design, by basing some of these programs on planted acres, you could also get around some of those equity issues. Next slide, please. And then, so just to conclude here, I bring up Tom Vilsack's statement a while back. I mean, clearly there's momentum to look at some of these equity issues, and I think a couple of the recommendations here to find new products and ways to attract new crop insurance customers into the fold, especially under these climate change scenarios where climate change is a bigger part of the portfolio. And then finally, just caps and policy design can both be used to provide more equity to subsidy and really disaster aid payments. So next slide is my last slide. Again, thank you so much. It's a great panel. Thank you for putting it together.
All right, thanks, Eric. Did we get Rod back? Rod, are you with us?
I think I am. Do you hear me okay?
Great. Rod will be our last speaker, and then we'll hopefully have some time for questions.
Okay, I'm sorry about that. So there's some fluctuation in my internet. All right, so thank you again for the opportunity to be here today. So I'm going to talk a little bit about crop insurance and unintended consequences for climate change adaptation. Next slide, please. So as Jesse mentioned earlier, agriculture is one of the most vulnerable sectors. It relies heavily on favorable weather outcomes to achieve good yield outcomes. Next slide, please. And there's a large and growing literature, as Jesse mentioned, that climate change, extreme heat affects mean yields and yield risk negatively. So it reduces average yields and increases risk around that average yields. Next slide, please. So to better manage this yield variability, crop insurance is the main centerpiece program, not just in the US, but globally. Next slide, please. And one thing to note here is that crop insurance likely affect farm management behavior. Just like having being insured and driving a car, your behavior may be different if you're insured as compared to if you're not insured. Okay, next slide, please. So our study addresses the question of whether crop insurance participation affect the relationship between warming temperatures and yield risk. So it has been established already from the previous literature that warming temperatures increase yield risk. So does crop insurance participation exacerbate that negative effect, essentially, is the question. And if so, that's a little bit of evidence showing that, well, crop insurance may be a disincentive to climate change adaptation. Next slide, please. And we used data from the US for the period 89 to 2017 for counties east of the 100-degree meridian. So around 30,000 for both corn and soybeans. Next slide, please. And then we used sort of parametric-based methods and a number of robustness checks to undertake the analysis. Next slide, please. And so the main result is that using this county level data, we find that counties with higher insurance participation tend to have larger impact of heat on risk, in particular variance and kurtosis of yields. And we also verified previous findings from other papers that showed that the heat effect on yields become larger for counties with higher insurance participation. Okay. Next slide, please. And so the negative yield effect essentially, or the adverse yield effect of warming temperature becomes worse with higher crop insurance participation. Next slide, please. And so essentially, this is an example. If the county has 10% participation, the variation is around 6.2 bushels per acre, given a 1-degree increase in daily min and daily max temperatures. And if the county has 80% participation, the effect of that same warming scenario is 8.6 bushels per acre. Next slide, please. And so again, that's sort of evidence that we're showing that the risk increasing effect of warming is further magnified under high levels of crop insurance participation. Next slide, please. And so this is essentially, as I said earlier, an implication is that it seems to be evidence that crop insurance provides some disincentives for adopting climate change adaptation, because we see that under high crop insurance participation, the risk effects of warming is higher. Okay, so and this may be an unintended consequence of subsidizing crop insurance and encouraging higher levels of participation. So essentially the idea is, well, why would I need to invest in climate change mitigation if I'm insured anyway? It's sort of the punchline here. Next slide, please. And so the policy implications is twofold that we think, is that first, we think that the conservation programs like EQIP or CSP may need to play a bigger role moving forward. So for policymakers, the question is, does it make sense to put more dollars in EQIP and CSP, knowing that there's an unintended disincentive effect of crop insurance on climate change adaptation? Then the other implication that maybe is important is looking towards crop insurance per se and see, does there needs to be any tweaks that has to be implemented in crop insurance to encourage climate change adaptation? So one example is the pilot programs in Iowa and Illinois giving premium discounts for folks who adopt cover crops. Given some of the previous research that cover crops is a climate change or a climate smart practice that could reduce the effects of climate change, does it make sense then to use that kind of discount for encouraging climate change adaptation to counteract some of this disincentive effect? So that's sort of, I think, some conversations on that perhaps is important given the results of this paper. And that's all I have. Thank you.
All right, thank you.